Good morning, good afternoon, and good evening, everybody, wherever you're joining us from in the world. As Chair and President of the Chartered Banker Institute, it is my very great pleasure and privilege to be introducing today's virtual conference. It's the first of two short days discussing responsible banking and how the banking sector and community are embracing digital transformation in the age of AI. This is in fact the 8th time the Chartered Banker Institute has hosted such a conference, and we are once again holding the conference virtually in order to reach as many of our members around the world as we can. I understand that we have significant numbers of people joining us today from Africa, Asia, Australasia, and Europe, which once again demonstrates the global nature of this conference. And for others joining us around the globe today, you're most welcome. Whilst our conference will focus on responsible banking, we'll be looking at this topic through a very different lens, that of technology, and in particular, AI. It is, however, appropriate to spend a moment, however, just reflecting on what responsible banking means. At the Institute, we define a responsible banker as one that is clear on what is the right thing to do in the interest of society, the environment, and for their customers. I'm sure we will touch on many of these characteristics through the course of these 2 days. I turned 60 this year, and I'm now in my 44th year in this industry. The scale of change in that time would take up many more hours than we have today, no more so than in the space of technology, which has transformed many industries and indeed replaced some industries. We all experience this transformation in our personal lives. You no longer need a space to house your favorite music, books, or films. You don't even need a device to store them on, just one to stream them. Indeed, your device will suggest media to you that you may enjoy, and you can ask your car to take you to the best local restaurant. You may not even have to drive it in the future. And whilst you may mention the idea of moving house to your partner, an email will arrive introducing you to property agents in that area. It's on the one hand incredible, but on the other quite frightening in terms of where that technology can take us, maybe to a point when our lives and choices are no longer our own. Once the stuff of futuristic or James Bond movies, now a real prospect, and one that every government, business, or body has at the top of its agenda. We've talked about how AI impacts our agenda at the Chartered Banker Institute. And as a group of trustees, we were struck by the breadth of its impact on what we do and how we work with our members and partners going forward. Today, we'll look at how AI and being a responsible banker interconnect. Whilst it's 15 years since the global financial crisis, the last year has been characterized by some significant bank failures. And these have required regulatory intervention and resulted in losses to equity and bondholders, proving the point that banking remains a significant risk concentration in any economy, and that risk can still run out the various liquidity and capital buffers that have been built to protect the system in the last 15 years. The greatest protection to any bank is its management and governance bodies. Their ability to understand the risks in their business model, make sure these are appropriately diversified, managed and monitored, and corrective action taken is the key to safety, sustainability, and investor confidence. That takes us to the place of concepts of professionalism and responsible banking that have been at the heart of our agenda for much of the last 15 years and will remain so, notwithstanding the aspects of technology that we will explore over the next couple of days. Our speakers and panelists today will be looking under the bonnet to see whether bankers have the right focus and skills to successfully navigate through the next few years, where technology and a challenging economic outlook will undoubtedly dominate many board and exco agendas. So please sit back with a coffee or whatever drink takes your fancy at this time of day and enjoy what should be 2 very enjoyable, thought-provoking days, looking at most aspects, if not all aspects, concerning responsible banking in the age of AI and the challenges and opportunities they are presenting to banks and bankers. Now, for those of you who may not already be aware, the Chartered Banker Institute was founded in 1875, so we have nearly 150 years of experience in educating bankers. And with a network of over 37,000 professional bankers around the globe, we're proud to be regarded as the voice of responsible and sustainable professionalism in banking, with a focus on responsible banking in particular. We emphasise the importance of education, skills and training in banking. We're one of the first UK organisations to endorse the UN Principles for Responsible Banking, and we also support the wider attainment of UN Sustainable Development Goals. Our work in supporting how banking can play its part in meeting the environmental agendas that the world faces led to the development of a unique global academy, known as the Principles for Responsible Banking Academy, or PRB for short. We undertook this in partnership with the United Nations Environment Programme Finance Initiative. The PRB Academy celebrated its first anniversary a couple of weeks ago, and it's provided professional training for banks and their staff on sustainability and social issues framed in the context of the United Nations Principles for Responsible Banking and the UN Sustainable Development Goals. The objective of the PRB Academy is to give all bankers, regardless of career level or expertise, the tools needed to apply a sustainability lens to their professional practice. Alongside this, the international influence and collaboration we've been building through our partnerships with professional bodies in Africa, Australia, the Bahamas, Hong Kong, India, Ireland, Malaysia, Malta, New Zealand, Pakistan and Taiwan, to name a few, has been a continued focus for the Institute. We're now proud to have both students and professionally qualified bankers in over 100 countries across 6 continents, all of whom share a common commitment to the Chartered Banker Code of Professional Conduct and to our global family of members. It is great to have so many of you able to join us today online for this conference, and I thank you once again for your invaluable contribution in making the Institute such an important community. I'd particularly like to pay tribute to our international partner institutes, the AICB in Malaysia, FinSIA in Australia, and also to thank the Global Ethical Finance Initiative, and last but not least, UNEPFI, for supporting this event for the next 2 days. And I give a warm welcome to all their members and all those associated with them for joining us today. It's partnerships like this that underline the strength of our banking community, and long may it continue. Events of the past 15 years have taught us a lot about responsibility, whether in adapting to changes in how and where we work, how we serve our customers, the communities we operate in, and the wider needs of a society brought together whilst physically apart. Earlier this year, to commemorate the 10th anniversary of the UK's Parliamentary Commission on Banking Standards report, Changing Banking for Good, the Institute published a joint retrospective white paper with the Starling Trust Sciences, which is a knowledge sharing based platform based in the US, which focused on culture and conduct reform efforts over the past decade. The paper featured a number of contributions from around the globe, including Baroness Kramer, herself a former member of the PCBS, Stuart McIntosh, a G30 director, Peter Routledge, Canada's Superintendent of Financial Institutions, and Claire Bollingford from New Zealand's Financial Markets Authority, and several others of similar station. The paper concluded that 10 years on, there remains a lack of focus on building professional cultures and standards in banking. This could leave banks and bankers not as prepared as they should be for some of the current and future challenges impacting banking, business, and society. The Group of 30, Stuart McIntosh, warned of the emerging knowledge gap for the next generation of banking leaders and regulators who have no lived experience of a financial crisis, whilst Jo Murphy from the Institute added in her foreword that if we really want to make banks and banking stronger, safer, and more resilient, then the answer lies not in policy, prescriptions, or regulation, but in the reprofessionalisation of banking. That's why we're hoping that this conference can draw together the challenges of building sustainable and responsible banking models with the opportunities and threats that the age of AI presents, interpreting what that means for banks, bankers, and society. We absolutely believe it is our Institute's role to help our members understand how they can apply the principles for responsible banking in their work life, what tools they can use, and at a time when customers' expectations and demands are changing, we want to enable our members to develop the skills and knowledge to support their customers. Stewardship is the word our founders would have used almost 150 years ago. Today, we would interpret stewardship as being responsible and sustainable, and that's why we define a responsible banker as someone doing the right thing in the interests of society, the environment, and their customers. As we look ahead, responsible banking needs to be led by professional bankers, and we need to ensure that the future of banking is one that reflects and celebrates the diversity of our world. We live in a global community, and it's absolutely right that we look outwards and face into the challenges that arise from the current economic uncertainty and geopolitical events, as well as climate change and the impacts of artificial intelligence, and the roles that bankers can play in meeting these unprecedented challenges to our industry, but also to the world in which we and our families live. And these are areas that I'm sure we'll touch on more than a few occasions throughout the course of the next 2 days. In the moment, we will hear from our keynote speaker, Dame Susan Rice, followed by Bill McCall, a past president of the Institute, who will be chairing today's panel and proceedings. Tomorrow, we're delighted to have Dr. Victor Dorfler from the University of Strathclyde, who's an expert on AI and ethics, and he will be joining us to provide a keynote speech. This will be followed by a discussion on how learning is changing in the age of AI. But today's topic for debate is responsible banking, our past, our present, and our AI-enabled future. So I'd like to thank you all for listening, and I'd now like to hand over to Dame Susan Rice for today's keynote speech. Susan, over to you.
Thank you very much, Steve, and hello to everyone. It was nearly 15 years ago, when the economy and the banking sector were at rock bottom, that I found myself getting into a taxi in London to go to the airport. As we drove off, the driver asked, "So what do you do?" He knew what I did because I'd just come out of the headquarters of my bank. I was dressed for the part, but I hesitated as I thought, if I tell him I'm a banker, he'll give me a lot of grief. It's been a long week. I really don't need that. But I had to say something, so I replied, a little tongue-in-cheek, "I'm a banker, but one of the good ones. In fact, most of us are good ones, so please don't pull the taxi over and make me get out." He responded, "I understand why you hesitated. Maybe you read in the papers last week about the taxi driver who was arrested for assaulting a passenger." At which point I thought maybe I should ask him to pull over and let me get out. But I stayed in the taxi, and on the way to the airport, I sat there thinking that there must be some way for bankers to do something for themselves, to be able to speak up for themselves and begin to re-earn trust. I start with that story from 15 years ago because it lets me look forward at what changes have happened within banking since and what's coming along. The global financial crisis of 2008, the GFC, was a watershed moment for the banking industry. It forced us to reevaluate our practices, our ethics, our culture. Banks exist to support economic activity and create and protect personal wealth. For some years, however, as banking became increasingly digitized, bankers deferred to the speed and apparent accuracy of the algorithms being created to quantify risk, to target marketing, to increase productivity, losing sight, perhaps, of how banking should be delivered, ignoring the how in favor of the what. Inquiries, public scrutiny, and navel-gazing followed the GFC. Banking regulators stepped up to the mark and enhanced the focus, rigor, and scope of their regulation. Indeed, today, on the back of major change, banks are now disciplined by a capital ratio. Banks globally can withstand far greater losses than ever, and the system can better withstand failure. Interbank lending has fallen by 2/3 since then, so banks are far less dependent on each other, and complexity, especially in the derivatives market, has been greatly reduced. But going back to that point in time, even knowing such transformation would come, and led by the Chartered Banker Institute, some of us believed that regulation alone wasn't enough, that change had to come from within the industry as well. Regulation provides tramlines in relation to current issues and tries to anticipate the future. But just like algorithms, regulation alone can't ensure that good judgments are made by every banker in every situation. Regulation only takes us part of the way. So we put our heads together and developed a framework for professional standards for bankers. The first time this had been done not just in the UK, but anywhere in the world. After all, the sector has a license to operate, it requires expertise and knowledge, and it's asymmetric in that bankers have more knowledge than their customers. These aspects make it a profession, even if we still call it an industry. Professional standards lead us beyond regulation and help us be accountable to customers, colleagues, and counterparties so that banking can deliver for the public good. Aiming to rebuild public confidence in banks and bankers, we also enhanced the Institute's Code of Professional Conduct, underpinning high ethical, professional, and technical standards. Over 1 million bankers and others have engaged with the code and standards, a big cultural change over the last 10 years, and a massive influence on our organizations. The regulator has kept moving as well, most recently introducing the consumer duty, which sets higher expectations for the standard of care that firms provide to consumers. Still in the early stages of rollout, it'll have significant impact on culture and banking. Now, if the Institute's Code of Professional Conduct is about each of us as individuals, and regulations such as the consumer duty is about the responsibilities of our firms, organizational culture is the space that sits between. Culture is often defined as how we behave when no one's looking, but actually it's about how we behave when everyone is looking. Your organization likely has values, and you'll have values as an individual, but culture is about a group of people. Culture reflects what's admired in a group at any point in time, and also what's deplored. That's what brings us to act the way we do at work. So why does culture matter? Well, in an organization, people can make just about any strategy work, and they can circumvent almost any strategy as well. How often do we hear the phrase, culture eats strategy for breakfast? It's the culture in the organization, whatever the value statement pinned up on the wall, which makes the difference in terms of implementation of strategy. It's the culture which will lead to the consumer duty having impact. It's the culture which will encourage our colleagues to act professionally. It's culture that makes the difference in terms of trustworthiness. On the back of game-changing work by the Financial Services Culture Board over 8 years, many financial institutions have learned how to shine a light on their organizational culture, identify weaknesses, and address them. And this matters as we look ahead, perhaps more so than ever. Think about the rise of fintech companies, which has nudged traditional banks to become more customer-centric, to transform their tech, to develop partnerships and collaborations with new fintechs. And there's cyber, with cybersecurity absolutely fundamental in banking. Yet as fast as banks and all businesses adopt more sophisticated safeguards against data breaches, those who would commit them find yet another way. And those solutions not only have to protect our institutions, but they must also avoid creating harm for our customers, colleagues, counterparties, because that's what the Code of Professional Conduct and the Consumer Duty require of us. I spoke earlier about the asymmetry of information between banker and customer. However, some bankers today might not quite feel they know more than their customers when it comes to AI. In fact, our businesses have been using AI-related technologies for some time in managing fraud, analyzing marketing trends, data collection and analysis, risk management and compliance, predictive analysis, and more. But the stratospheric rise in focus on AI over the last year, the ease with which we can individually access and play, for instance, with generative AI, has increased the digital heartbeat of our industry. But we still have to navigate through economic uncertainty and volatility on a global stage as the world stutters towards net zero and beyond, and we have such a major role in making that happen. I began with a personal story about my taxi ride in London 15 years ago. I knew then, and understand all the better now, that however much we use and are used by AI and digital tools, banking is delivered by people. We have to maintain our grip in that wider context. We have to remain in charge, in control. So I'll finish with another journey of a different sort. ChatGPT, sorry. I hadn't yet made time to play around with it. So I decided before starting work on these comments to do just that. I gave it the topic I'd been given, provided the context, and requested a speech. It responded in the blink of an eye. The speed was incredible, but what it produced was a bit curious. It gave me a short document structured like an outline that one would have learned as a school child, using language that to my ears sounded about 50 years out of date, far too formal. I don't mean to criticize, however, because it also pulled out some of the key themes I intended to talk about. Did I use any of its content? One sentence, because it was the only sentence that sounded a bit like my voice, and it was one that I could verify. We're all immersed in the world of AI far more than we've realized, but we see it more directly now through foundation-based models such as ChatGPT and the ongoing debates about blockchain, about tokenizing securities and other real-world assets, about all the change that's yet to come. The industry is indeed transforming at pace, but every new thing has a good side and a bad side, so we mustn't be lured into complacency. We can't let technology, the digital underpinnings of our business, even with all their benefits and the excitement of AI, however inscrutable it is, we can't let that make us forget that it's we who have agency. And with that agency comes responsibility. We mustn't lose sight of that again. 15 years ago in that taxi, I believed that most bankers were good ones, but there needed to be work to regain our reputation, to earn trust once again. Today, in the world of AI, cyber sustainability, economic volatility, geopolitical upheaval, and more, if we operate to the Institute's Code of Professional Conduct, we will keep our determinism, keep our humanity, and keep the confidence and trust of those we serve. I can't think of anything more important. Have a great conference. And now I hand over to Bill McCall, who's chairing today's panel for what is certain to be a fascinating discussion. Bill, over to you.
Thank you, Susan. Well, good day, and good day to you wherever you are in the world today. Whether you're watching this live with us, and there are a good number of people online right now watching live, or you may be watching this event later on catch up. Well, welcome to this annual conference brought to you by the Chartered Banker Institute. We are the oldest banking institute in the world, and looking forward, as Steve alluded to, celebrating our 150th year in 2025. Our thanks collectively to Steve Pateman, the current Institute President, for his words, and also the keynote speaker, the invaluable advocate of the banking profession, Dame Susan Rice. Now, I should also say an echo of thanks to our supporters of the conference at the UN, the AICB. Hello to those of you in that particular time zone out there in Malaysia and beyond, and to Jeffy too. Now, we turn to our subject of choice for today. For those of you, and I know there are some of you online and perhaps watching on catch up who lived through it, it might be impossible to believe that what Dame Susan alluded to and talked about, that financial crash, was 15 years ago or thereby. Now, a whole new generation of bankers has emerged, and they perhaps don't think of themselves as bankers. And perhaps we have forgotten the basics of responsible banking, a question, and what new challenges await this whole new cohort of bankers around the world. We only have one reputation, and it's collectively in our hands. Now, the panel we've gathered this morning is wide-ranging in experience and perspective, and I expect we are all going to pick up a lot of value in the next hour or so. Now, aside from the panel discussion, there will be some time for a Q&A, questions and answers, and I'd ask that you log those using the Q&A function. Don't butt in and raise hands. We'll try and manage all of those as best we can, and I apologize in advance. We may not get to all of them, and I will try and group similar themes together. So to our panel, they'll each in turn give you a bit of background on their careers and why they are here. You will find lengthier career CVs and biogs on the conference page via the website, of course. Now, Dee, good morning to you, first of all. Please, over to you to give our audience a short introduction.
Thanks, Bill, and good morning. I am Dee. I am a sustainable banking advisor. I have 10 years of banking experience, which probably puts me in the cohort that Bill just mentioned, the new generation of bankers coming through. Although I will caveat that and say, I don't think we've forgotten the principles of responsible banking. Recently, I have taken a step away from frontline banking. I worked at 3 separate banks individually, and I'm now advising banks directly on how to be more sustainable in their banking practices, as well as being involved in sustainability and climate innovation at a venture capital-backed incubator.
Thanks, Dee. Mary Kay, good morning and good day to you. A quick potted history of where you've been and what you've seen over the last little while.
Great. Good morning, everyone. So I am Areika Leyendijk. I'm actually in Dubai, dialing in from Dubai, and I am currently with the DIFC, the Dubai International Financial Center. So we are like the Wall Street or the Canary Wharf of the Miyasa region. We have about 6,000 companies comprising a 40,000 strong workforce on premise in the DIFC, and a very big part of what we do is around fintech and innovation in the fintech space. My role at the DIFC is I head up the DIFC Academy, and we cater to the education and training needs of our community, of which bankers and the financial community is obviously a very big part of. I've always been in education. I fiercely, maybe naively, believe that education creates futures, and I'm very happy to join this discussion because I believe training and education is such a big part around capacity building and so important for what we will be discussing.
Okay, thank you. Carino, good morning or good day to you. Over to you.
Good day, Bill. Good day, Bill. Thank you for having me. It's a pleasure being here across a multitude of panelists here with a number of experience and to contribute to this prestigious conference. I've been in banking for the past plus minus 20 years, particular focus in delivering and shaping corporate strategies when it comes to client and service transformation through technology. I've been involved in several geographies across, particularly in the Southern African region and also East Africa, from microfinance all the way to multinational financial institutions. And my personal belief and contribution, hopefully, is to inspire individuals to help shape a world that we can offer world-class financial services that are open and available to all. Thank you.
Thank you, Karina. Areika, you mentioned at the start about your passion for education. I wonder if you look in a rear view mirror to the last 15 years or so since the great financial crash that Dame Susan alluded to, do you believe there's been a cultural change over that period? And has it been more recently or latter, or hasn't there been at all? I'm keen on your observations, as I'm sure our audience will be, on how you see the panoply from that time.
Yeah, I think we still have a long way to go as educators. I think that was certainly a catalyst for us to rethink business education in general and finance education specifically, especially during that time. MBA programs were seen as the culprits for educating graduates that only care about the bottom line and not paying any attention to the role of business in society, social responsibility, etc. There's been a lot of initiatives that I think has been super useful. For instance, the United Nations Principle of Responsible Management Education, institutions like the Global Responsible Leadership Initiative, and the list goes on, of sort of think tanks and bodies that try to install a way of teaching where we think about more than just the bottom line. But here the key caveat is, while still thinking of the bottom line, it's not about being green, it's not about doing good, it's really about infusing sustainability or ESG into every part of the curriculum. And just mentioning that term, I think we've come a long way in just defining what is it that we need to teach. And there's still contention around what do we actually call it, but it's not just about nature or climate change. It's really about the whole ESG spectrum. So I think that's one thing. There's much more awareness. We know better how to identify and define what we need to teach. And we're still trying to see how do we embed that, knowing that we need to make sure this is taught as a business principle and not a nice to have. Another key trend that I think came from that is all of a sudden we realized it's not really about knowing 1 + 1 is 2. It's very much also the softer skills around that, around being able to cope with change, being able to anticipate and deal with risk, being able to do stakeholder management, etc. So I think we've come a long way in finance education, business education, to ensure that it's an all-rounded, really education that looks at aspects of leadership, that looks at the softer skills. And that that's really important for us. And I think it will be much more important moving forward, using the cliche about AI and technology taking over jobs, echoing what Dame Susan said, that we're still going to need the people, but these people would not need to tell us the technicalities. They would need to tell us, how do we interpret that? How do we make the links? How do we connect the dots? So I think that's another key thing that's really important. And then just the final point along that is, we've started doing that, but I think we need to do more around interdisciplinary collaboration. We need the social sciences to also be part of the finance teaching, and the other way around. We need the environmental engineers to teach in our business schools, and the other way around. We really need to ensure that there's cross-simulation and cross-stimulation across between disciplines, because if we want to ensure change and if we move forward in this very volatile future, we cannot operate in silos. We really need to use the expertise across sectors.
So just as a follow-up to that, then, you're suggesting that we have to be much better at collaborating with multidisciplinary views that impact, because if we operate in silos, as it seems we have in the past, we cannot recognize what's going on either side of us. Is that fair to say?
Indeed, and I think if we don't have an understanding of what, let's use climate change as an example, if as a banker you do not really get what climate change is apart from the buzzword, it's much harder to navigate that, right? It's much harder to implement, devise and implement principles that can combat that. So I think that's really important. And something else which we have been good at doing, but more and more and more, is also industry participation, to make sure that it's not at the risk of maybe offending anyone in the room, but that it's not academics teaching a PowerPoint from 20 years ago and thinking this is equipping graduates for the finance future. So really ensuring that we have real applicable practical content through also industry participation and input.
Yeah, I think we've all seen more than enough PowerPoints in our lives. Carino, from your perspective, where you sit looking at the global position, the catalyst of change probably that accelerated a lot was the COVID pandemic internationally, with a sort of forced digitalization of many professions, not least banking. What do you see, though? Are we in danger, or have we left people behind? And have we now got a multi-tier system of haves, have a bit, have not? I'm interested in, from where you're sitting, how you see that.
Thank you, Bill. I think they say, and this is someone saying, and that says there's, when COVID-19, there's the COVID-19 winners and there's the COVID-19 losers, and there's the in-between. But something that is undoubtedly happened is that across many industries, across multitude of disciplines, including banking, it has accelerated digitalization. I think that's something that we all have experienced, that we all have had to adopt, and we had to do that as a survival mechanism, if I put it this way. It didn't allow us the normal transition period that you learn, unlearn, and you get to the new stage, right? And you can choose between adopting or not adopting. This was really a forced move. When I look at those who have succeeded, is because they had the foresight. Therefore, I had the foresight in terms of investing in technology, learn technology. When I talk about investing in technology, whether it's from an organization perspective, industry perspective, that you have adopted new technologies and your institution is able to cater for, but also from the client side, the individual side, that you have adopted, you have transitioned, and that was easy for you to then, lead your life based on technology at large. Has that increased this gap between those who were more accepting and more easy to adopt it, and those who are not? Yes, that happened, and I'll get to it just now. We've seen an increase in digital services. Everything became digital oriented. Customers didn't have to go to branches, couldn't go to branches. When you talk about the financial systems, you had to do everything through your phone or through a website or through your computer. You had you couldn't engage with the individual in presence. It's to a voice. Everything had to change. It has also created potential for exclusion when you talk about certain demographics and those who also have or don't have access to technology. Bringing some input and reality from Africa, for example, and especially in the area which we operate. Not everyone has access to technology. Not everyone has a smartphone. Not everyone has a computer at home that can access banking, and that was extremely difficult for them to be able to cater with that. To even though then classes at school, right? I mean, schools became digitally oriented. This also opens, and I think it's important to bring the other side of the coin, which is it's also opened the opportunity for inclusion. In scenarios where we couldn't reach clients or customers because of infrastructure, whether it's roads to get to or buildings that we could operate in certain instances, we use technology to reach them. And that also helped in bringing those who ordinarily wouldn't have access to the banking or financial services to now start adopting that. How do we solve some of the issues or challenges that I've mentioned here? I think from a banking perspective, digital literacy is critical, that we help those who are less prone or less access to technology to now understand more about technology and how they could use it and use it in the correct manner. We also brought in aspects of cybersecurity or cybersecurity awareness, because that was also on the rise when with the pandemic and everyone becoming digital oriented and not everyone being prepared to run, for example, or do financial transactions in a secured environment. So how do we do that? How do we explain our customers and the do's and the don'ts? What should you do in your cell phone? What you shouldn't do in your cell phone? What you should have in your computer to make sure that you run transactions in a safe environment? And then the second aspect, which is the post-COVID-19, where we had the spike in terms of learning and adoption of technology. Now we're in a position to say that we have learned also to trust, which is a big challenge from a human perspective. I mean, we inherently we're hesitant, we don't trust. It takes time for us to get to the other side, and COVID took us immediately to the other side. Now that we have learned, and this is the point, now that we've learned what we've learned through COVID, we can't just let it go. I think there's a lot of good that came through that. There's a lot that we can adopt going forward. And I think we have to strike here a balance between the traditional model and the new model, which I would term to be the hybrid model. I think it's important, and also to make sure that we don't create this gap, that we offer traditional banking to those who need to go into traditional branch and engage directly with a human being face-to-face with their bankers to understand their financial needs. But also for the different generations who, they really don't have particular interest in going to a branch. They feel that they can do everything through a phone, and they push the boundaries when it comes to us financial institutions offering them solutions that cater for their needs. So this hybrid model between traditional and digital is fundamental. And last but not least, and not by any order of priority, is from a regulatory perspective. And I think we've seen this in a number of geographies that we operate that have had access to, that regulators are way behind when it comes to digital, and there's a number of challenges when it comes to adoption of digital, whether it is from client information being available and shared across multiple platforms, but also how do you protect the end user? How do you protect the customer? How do you make sure that if anything goes wrong through that financial transaction in a digital environment, you would have a similar likewise secure environment as it would have through a branch or through a normal channel? I think that's just some of the points that I would like to share here, and I'm open for any.
So I'm going to sort of pin to the wall the point of trust and client relationship. And Arike, I'll come back to you in a second. Dee, you've been in banking and you're now advising outside, inside, if it were. Poach your turn, gamekeeper is the phrase that we use in English. COVID was the accelerant for a lot of things. And it seems to me that there is a new world order of banking being shaken out at the moment. But there's also, Dean, I know you've spoken about this before, and it's discussed widely, the triple planetary threat that's out there for us. Perhaps just give us a flavour of your view on that contextually, and then how you see that panning out over the course of the next little while.
Yeah, sure. If I can just add one point to the exclusion discussion, though, and vulnerable groups, I think the discussion is often focused on, for example, bank closures and the impact that might have on vulnerable populations around those bank branches. And we absolutely should be thinking about those things and making sure we continue to service customers who might not otherwise be serviced. But I do want to point out some of the ways that, digitization is being used for good. So there's examples of responsible lenders increasingly using open banking data as an example to supplement their decision-making processes when helping people with poor credit scores, as an example, who might not, for various reasons, have understood the impact that their actions were having on those credit scores and now excluded from debt. And I think that that's a really positive use of digitization. That the key point there is really that we have to be aware of vulnerable populations when we're making decisions, either, whether they will impact them directly or otherwise, just to think about who else is impacted. But to your question, Bill, on the triple planetary crisis, I think it is helpful to help define what that actually is for people. So it relates to three main interlinked issues that humanity currently faces. So that's climate change, pollution, and biodiversity loss. And each issue needs to be resolved if we're going to have a viable future on the planet. Now, of the three, I think banks have been most proactive when it comes to climate change, both in regards to risk. It's largely now recognised as a material risk for banks and should be included in all of their credit decisions. Every financial decision is a climate decision and vice versa. But it's also been considered increasingly in the form of actual financing of climate mitigation and adaptation through sustainable finance. For pollution, I think the focus has been on banks' exposures to high polluting industries, and that's being addressed through banks' individual transition plans. And then I think the interesting one of the three at the moment is biodiversity risk. And that's really at a more nascent stage than either of the previous two. And the interesting thing for me is, well, we know that 50% of global GDP is reliant on nature. That's from the World Economic Forum. So from an economic standpoint, we should be treating biodiversity loss and nature risk as a material risk. But as an industry, I think our thinking still has a way to go. So how is this changing the world order of banking? Going back to the culture point, a lot of these themes are really interlinked, but ultimately as bankers, we're judged externally. We're judged by other stakeholder groups, whether that's our shareholders, whether that's clients, and equally, increasingly it's bankers themselves. From a banking perspective, there was a study recently released by the Finance Innovation Lab, and they surveyed a group of bankers working in a range of roles. And one of those findings was that not a single respondent thought that the banking sector as a whole is doing enough to keep warming within the 1.5 degree target globally. And equally, if you take that down to an organizational level, 90% didn't think that their own bank was doing enough. So that's from the employees, that's from the bankers themselves. And then from a consumer perspective, there's increasingly tools and league tables available to consumers ranking how in touch banks are on these various issues. For example, in the UK, there's a service called Mothertree, which provides literally a league table. And you know, if I was leading a bank, I would not want to be at the bottom of that table. It doesn't mean that, you know, to Marika's first point, that we have to have planet and people at the core of what we do. Profits are also important. However, we do have to consider those factors when making decisions. And so full circle moment, how does that relate to digital banks and digitization? Digital banks actually have an advantage here, and that's because they don't have a physical presence. And typically they have a very limited commercial book, but it does leave the sector really wide open to banks that are going to center around people, profit, and planet. And there are a few really good examples of that already occurring.
So taking that point, Arike, the trust point, are relationships then breaking down, or have they not been built up again? I'm slightly confused about the picture, because it seems to me that it's not one thing or the other. It's slightly grey in its complexion. It's difficult to say from where you're sitting. Where do you see that particular point of relationship between institution, profession, and client customer, and where has that got to?
It's really dependent on the sector and the customer that we're talking about. But fundamentally, banks have to put clients at the center of all of their decision making. And I think that is the aim. It's not as though, you know, bankers are going out there and not putting clients at the center of the decision making, but it's an increasingly complex world. We have more and more things to think about, more and more levels of risk, and sometimes it's easy for it to kind of get muddied in between other things. So it's drawing the customer back into the center, and I think a really easy way of doing that is enabling bankers to make decisions themselves that are relevant to the sectors and the clients that they're serving. So it's not setting strategies necessarily at the top, but allowing, you know, middle management and the bankers themselves to own those relationships and kind of feed up what actually needs to happen and what clients want from us.
So Arike, from your perspective, where do you see that point? Because I know that from an educationalist perspective, trust between the two parties is quite important, in fact, quite paramount. And Karina had already mentioned the trust point, that inherently humans, trust has to be earned. It's not just given. So I'm keen to hear your institutionalized view of where that might be.
Yeah, and I think it comes down again to, we're not speaking about finance at all here, right? If you speak about trust, you're speaking about people, you're speaking about leadership, you're speaking about risk taking. So I think that's why it's so important that, first of all, we teach this, as I already mentioned, in terms of leadership skills, relationship skills, etc. But then the other very important thing that I didn't touch upon initially is that we make sure that we curate training environments, be that a classroom or just a group of participants, that reflects the global business landscape in which they operate, so that they have a safe environment to learn these lessons, in a sense, right? So that it's just a classmate saying, what you're saying doesn't make sense. I would never have trusted what you said, or I would never have gone with that decision. And then you have a facilitator, a teacher, if they know what they're doing, that can really draw this out, and the learning goes from there. And that equips them to then, when they're out in the real world, when they encounter similar situations, to know how to adapt. So I think that's very important. And the other key thing, which Karina and Dee adding on to the differences in terms of institutions, type of people, is also the regional differences, right? I think it's also very important that within a class that we have multiple perspectives also when it comes to regions or demographics where people come from, because trust itself, I think, is culturally viewed very differently, and that we're not even at the finance trust angle yet. This is just the very basic human level. So I think even more so, it's about ensuring that we can create environments where we can have our students learn these lessons and sort of make the mistakes in a structured environment. Maybe they make a mistake based on not understanding the culture, not understanding a product, not looking at the greater context, etc. But that's really important to do. And I hope, and I do believe that that will already go a long way towards knowing how to gain the trust and keep the trust of those that you work with.
So making mistakes is something we should encourage and use it as coaching moments, whereas perhaps culturally, several decades ago, mistakes were punished. And within a financial environment, regulated environment, it's quite difficult. I have a number of Norwegian colleagues who tell me that there is no such thing as bad weather, only inappropriate clothing. And I think that's potentially what you've described, that we have to have the skills and toolkit to be able to deal with whatever is out there. And it begins, funnily enough, on a people basis. Carino, you have an interesting perspective on the world from your geography. And there have been, in the last number of months, some highly significant bank failures, albeit regulators have stepped in both the US and partially in the UK because of subsidiaries and in Switzerland. Do you think that post-COVID and where we are now, that the sort of ranking order of world banking control is beginning to move much more internationally than perhaps being centered in what I describe as the old centers of excellence? Is that a fair observation?
I totally agree with that notion and that view. And I think out of the crisis, maybe just a few moments to explain a few points here. One is that you see, first of all, an increased regulatory oversight. From a regulatory perspective, there's a stringent or more regulations to ensure stability and availability of banks. That includes stress testing or closer monitoring of banking institutional banking practices specifically. And also, there's another shift when you look at how banking regulation or financial system regulation is evolving versus how technology is advancing from a speed perspective, and how that's becoming now more prominent or more available in areas that used to be lagging, right? So if you look at the West and et cetera, and how technology is impacting the financial systems there, and you look at Africa and how technology is impacting, especially to reaching non-bank customers or unbanked customers or population, that you see a massive shift. Now, if you bring in the situation that happened and what you see now in this move, especially supported by technology in Africa, advancing as reaching unbanked populations and so on, you see two things. One is that there's a major reliance now on technology in these regions, and regulation is still falling behind. Is this now a scenario for a potential challenge in the future? Yes, I think there's a potential risk here, and there's a need to play this catch up in a much quicker manner, but also not stopping the progress that we've seen today. So I think there's a balancing act that needs to take place here between allowing this democratization, if you want to call it, of financial services, and allowing it to reach to those who were less privileged and to regions that were not possible before, versus ensuring that we have and build a sustainable environment for financial services and for those who use it in the correct manner. I think that's one point I think it's worth mentioning. The other aspect I think to bring in, linked to that, is you've got the traditional banking and the non-traditional institutions or financial institutions. And here I'm talking about fintechs, the advancement of digital wallets, and just to bring perspective in terms of the risk and the point that you've raised in terms of failures in the West, and now this shifting in the area that we operate. I think it's important to mention that you see those who are under a more stringent regulatory environment being able to reach or to catch up to those who have less regulation. I mean, here I'm talking about the fintechs. I'm talking about those who are digital wallets, who have potential risk, high potential risk, because they are less regulated. They cover probably more population today than the normal banks. And just to give you perspective, in some of the regions we operate, you see banks holding, for example, the fourth position with 250,000 clients in their books. But you look at the fintechs or digital wallets having 6 million, 7 million wallets. So how do you balance that? And I think
so you've described what could be a vacuum, and the fintech solution has filled the vacuum. And there is a question from one of our viewers today about cryptocurrencies and wondering if they will eventually cross over and become mainstream, because at the moment some people consider them to be slightly on the outside. And in the core central part, you have a regulated banking industry. You then have the fintech sitting in the outer ring, and then you have the cryptocurrency sitting on the further side. Some consider them to be slightly more Wild West than anything else. So I wonder then, Dee, coming to you, when you hear that, the responsibility for bankers who want to be good stewards, should we be doing more for the clientele and not leaving those behind? Or is it, going back 15 years, simply a P&L consideration for the banks to say, look, our responsibility in life is we have a license to operate. So long as we operate in a fit and proper way and fairly, the social responsibility isn't ours. I'm just being provocative, Dee. But I'm wondering what your sort of commentary on that part might be.
Sorry, I missed you asking. I might jump in.
Yeah. So the key point, I suppose, is how far does the responsibility for banks go?
Yeah, it's a good question, and it's an existential question. So I'm not sure I'll come up with the full answer, but I can certainly weigh in. From my perspective, I mean, you mentioned an important point, which is we have a license to operate, and we need to respect that and operate within those confines. However, we do need to take into consideration broader societal needs, because society is just a group and it's reflective of the group of our clients. And so therefore, we wouldn't be servicing them if we were omitting large sectors out of that. A good example is the finance gap within sustainability and in terms of other societal issues as well. So the World Bank estimates currently that we need about $5 to $7 trillion per year to achieve the UN Sustainable Development Goals by 2030, and that's globally. And that scale of the pure scale of that means that public funding alone won't be sufficient. And it's estimated that 80% of funds required will need to come from private sources like banks. So really, we do have a fundamental responsibility to step up and start filling that. At the moment, we've been increasingly focused on green and sustainable finance, which is absolutely necessary. But even in that space, we're not meeting the need. I think annual green bond issuances are at about 520 billion, which is just a fraction of the 5 to 7 trillion figure that we're talking about. And I think we need to take a step back and kind of reframe the thinking around this. And there's two ways of thinking about it. The first one is that this funding gap is not just a commercial opportunity, which it is, but it's also a fundamental risk. So for example, in many cases, climate risk is directly related to credit risk, and either banks can help fund mitigation and adaptation, or they can deal with increasing risk of stranded assets, not just in sectors that the conversations typically are focused on, like oil and gas, but really large sections of banks' balance sheets, like their property book. And you know, from my perspective, I am predominantly a property banker by background, so that's kind of my spot and the bit that I think is needing a lot of funding. So on the one hand, we have a huge commercial opportunity of plugging the finance gap, and at the same time, a huge commercial risk of not doing so. And so that directly correlates to how much effort banks should be putting into solving this. And that's a huge amount in my perspective.
Yeah, and I suppose the banks are only as strong as their depositor base, their credit score as an entity, and their ability to raise finance and then have a track record to lend into these circumstances. So buying money and selling money. Yes, go on.
Sorry, if I may, just to sort of jump in on the responsibility piece. I think a bit of a blind spot for us as a banking, as a finance industry, is the startup and fintech scene when it comes to responsibility in terms of the finance gap, etc. I know that I'm guilty. I'll give one example. We had a climate finance training series leading up to COP28 that's in Dubai this year. And I realized we don't have one fintech or sort of startup on the panel and on the programming. And I think for us, there is an obligation to sort of start them early, in a sense. When you're in startup mode, you really don't have the capacity, the resources to even think about this. You're just building the company, their expenses, etc. And I think very often instilling that ideal, I think it's not a lack of goodwill. It's purely just a lack of capacity to be able to think about this. So we have a lot of startup incubators that speak about scaling, investment, funding, but very little that actually pay attention to this, because also, especially attention in terms of, as you scale your business, as a business principle, how do you pay attention to these issues? Because exactly to Carino's point, 10, 15 years from now, this probably will be the predominant sector. And we see a lot of these as I sort of call it the suits versus sneakers type of banking institutes, but a lot of them will be the key and the biggest bankers. Carino mentioned some of those numbers. So we do need to, and coming back to training again, but across the board, I think we need to start sort of earlier in the fintech space, and make it easy, by lack of a better term, to pay attention to these issues. If you don't have a chief sustainability officer, or you don't have a green finance department, or whatever the case may be, to say that these are some of the things to pay attention to now, and this is how you embed this in your future strategy as well.
So the entrepreneurs starting those businesses, I guess, have survival and success in their minds. They're not thinking about they don't think about a regulatory department on day one. They're not thinking about a green sustainable officer, are they? Dee, you were going to come in.
Yeah, I mean, I completely agree with that. It's part of the reason that I split my time working with established banks and equally with fintechs and startups, because I do believe that actually that's going to influence the broader landscape in the long term. And so we need to be having these conversations up front and giving people the skills and the context to think about it. And when we talk about training, I think it's really important to bring it back to why are we talking about this? And so if you frame it in the context to an entrepreneur of actually, this is going to help you be profitable in the long term, this is going to help you raise investment, these are the reasons why it's important to start embedding these practices at the beginning, that's going to equip them and motivate them to really focus on it. So yeah, absolutely important.
And the bricks and mortar banking profession, and there's a question from another of our viewers this morning, there is still a debate about should we be in an office or not in an office. And the questioner is asking for our views on that. But there will be some in the fintech space who would say that's not that relevant. We will be wherever we need to be fit for purpose. And some would argue, perhaps tongue in cheek, that it's simply to fill real estate portfolios, that they want people back in the office. Or am I just being the agent provocateur that I'm supposed to be? Karina, what's your view on that?
Thank you, Bill. I think it's an important question. I've tried to capture that in my first intervention, where I said, with COVID-19, there was a lot of learning. I think there was a spike in terms of adoption of technology. We had to adopt working from home and so on. And now we're trying to normalize it. We're trying to go to a norm. And I believe this is a new norm, right? We can't go back to the old ways. We can't go back to the extreme that we were from a COVID-19 perspective. And certainly we've learned a lot. So how do we apply that learning into the new ways of working and living going forward? I think this is the challenge that we need to look at. And we need to find the balance in between, right?
Yeah, we do.
And I think
yeah, go on.
The operative word there indeed is balance. And just another comment is, I think, especially when it comes to banking, a lot of systems and processes are not geared up yet for completely online. I'll use one example. I needed a visa for a specific region in the world. I won't name names. And I had to show a bank statement in the currency of that country who has a physical branch in the country, in the city I was traveling to. And I'm like, I only have digital banks and international currency. So I had to physically go to a branch to actually open this bank account for the sake of getting this visa. So that is an extreme example, but I think it proves the point that it is really about that balance, and you're always going to have, from a customer service perspective, always those that want to see, especially when it comes to money, they want to see a huge amount of money. They want to see somebody personally, potentially even at their home, advising them. Whereas with others, they just want to click a button and everything is done. And I think especially as the fintech space still evolves, as the trust, coming back to trust, is being established, you would always need to have both. And yeah, we'll have to see if ever we move to purely online, but I think it is that balance, both from working, but also just from what consumers want, what customers want, and what policies dictate.
You've just described a perfect human intelligence solution to a compliance problem. Which is to physically walk somewhere and open an account to satisfy a requirement that seems somewhat odd to describe it that way, to find the solution. I'm not sure when Dame Susan was describing using an online system to create a speech for her, I'm not sure the AI would have found that solution for you. It certainly couldn't have represented you in a physical branch somewhere in a city of your choice. I think that's quite an interesting example, that humans will generally find the workaround involving bits and pieces. Karina, you're nodding. Clearly something that was said triggered another thought in your mind. I'm keen to hear that train of thought.
Thank you. And I think it goes back to two things that America tried to allude to as well, which is, one, you've got an ecosystem that is not fully digital. And when we talk about ecosystem, is those who also interact outside the banking environment that would require some sort of physical, whether it's a physical contact or physical document or whatever not. So you need to cater for that as well on the way forward, until, whichever position we get to. I think the other aspect which is important to mention is we are human beings. At a particular point in time, you need to establish an emotional connection. Banking is not just about transaction. It's also about understanding the needs. And the best way to do that and to build that emotional connection, that at least we know today, is that physical face-to-face engagement. So this is why I advocate for a hybrid where we need to adopt digital, but with balance on traditional. And you need to understand how best to leverage both. I think there's beauty on both sides.
Some people like to do business with other people. I get that. Our audience are being far too polite, so I'm inviting them now to please add any questions to the Q&A section. I know that some of you feel that you need to be invited to do so. Others have already crashed in and asked questions. So if there's anything you would like the panel to address, within reason, I might add, we will get to those as best we can. Dee, if I can turn to you, given that we're moving into that part where we anticipate some questions from the audience. As you look ahead, clearly you are an optimist. I suspect anybody who's in business has to be an optimist. No one sets up a business simply to do spreadsheets and compliance and whatever. Well, some might. Some of our members might. As you look ahead, what troubles you, but what gives you hope?
Big question. I'll lead with what I quite enjoy a spreadsheet, so that doesn't bother me.
Yeah,
too
who
much.
doesn't? Who doesn't? We're all at spreadsheets.
We're bankers. We,
Yes,
even
yes.
the digital wave is coming. A lot of what we do is built on spreadsheets, so we work our ways around it. What troubles me? I suppose the pace of change troubles me a little bit. It is still very, very slow, and particularly when it comes to societal issues like climate change, like some of the things that we've been talking about, the pace of change needs to be faster. What the flip side of that, and what gives me optimism, is I do think that we're able to meet that challenge. However, it's going to take up, banks some rethinking and putting the resources in the right places, and trusting bankers to work collaboratively with other banks, with other institutions, with government, with clients, with institutes like the Chartered Banker Institute or the Green Finance Institute, or enabling bodies to meet the challenge, because fundamentally some of these solutions don't exist right now, particularly when it comes to funding solutions. But that's exciting, and it just means that there's something new to create. So that gives me hope. So
if Arike, we were looking 5 years ahead. Now it's often the situation that banks tend to look 5 years ahead, or 3 years, or 2 years, or whatever. And a very wise person once told me that things within a year tend to be much quicker, but anything beyond a year tends to be much slower than human expectation. If we were looking at a sort of between now and 5 years from here, sitting where you are in the world, what would your concerns be for the profession in the whole move to further digitalization and less people? What would be the threats and opportunities of that?
For me, a big threat is maybe a strong term to use, but sometimes I'm concerned that we're moving so fast that we're not taking a step back to think about what is changing. And I'm going to sound so pedantic and academic maybe, but to really also look at the academic grounding in a sense, or just the grounding of what is changing. I think it's so much, especially in the region I'm in, which is amazing. It's part of what makes us work. It's the future, and we just make things happen. But if I had a magic wand, I would urge the whole sort of banking community to consciously just sometimes take a step back to really look at what is the grounding of what we're doing, and also to try and separate the buzzwords from the actual substance. I feel very often we all jump on the bandwagon. It's a new word, and we all throw it out there, and we try and set something up in that vein. But do we really know fundamentally what that means? So for me, that's sort of concerning. But the opportunities around that is just that it doesn't really matter where we are, right? If we want to solve these, we spoke about regulation, we spoke about the finance gap. If we want to solve this, we can really, as a collective community, tap into the expertise and the input from everyone, right? So I would hope to see more and more working groups, advising groups, saying this is what we think should be happening, or this is what's happening in terms of regulation in our region. What is your region doing? Where are the best practices? Could be an industry voice to maybe also advise regulators or policymakers, or whatever the case may be. So that gives me hope that we have these opportunities to collaborate and to see how can we put some structure, is probably not a word I should use. Some people are allergic to it, but how can we ensure that we, in this fast pace, still pay attention to the grounding and what really matters? within these changes?
Now, where I sit in the Northern Hemisphere, temperatures will drop over the course of the next few months, and some things may freeze, as in lakes and, well, in Scotland, lochs, for those of you who wonder what they are, it's just big lakes and whatever. And what you've just described there tends to suggest to me that we're running out there in faith, not recognizing there may be thin ice ahead. And from time to time, we have to do a depth check just to make sure that we've got some strong foundations on which to build the next stage. Otherwise, I guess we're in danger of having a further house of cards in due course. Dee, there is a specific question around the energy space. How do you see climate targets being met, given the significant carbon footprint, the geopolitical changes that have happened in the last number of months, perhaps year or so, the movements of the way gas is now shipping around the world to meet different needs, etc. So how do you see the climate targets being met in that specific space? It's the obvious front and center one, isn't it? So just keen to get your views, and thanks, Gilbert, for that question.
Yeah, it's a really difficult one. I suppose the geopolitical factors that are going on are largely outside of our control, so that's not something that we can particularly influence. But when it comes to, future investments in various regions, it needs to be focused on green energy sources and transitioning to those green energy sources in a manageable way. That's, keeping the just transition in mind. So that's making sure that no communities are impacted more than others. From my perspective, a different way of looking at it is focusing on, we can green the energy that we actually produce, or we can reduce the carbon emissions and the energy demand on the sector. And so, something that I like to talk about or give an example of is actually globally 40% of energy use comes from the built environment. So that's from buildings and transport. And so perhaps taking an alternative view and focusing on those sectors and ensuring we're decarbonising those sectors and reducing our actual energy use and demands in those areas can be done at the same time, because that's something that we can influence as opposed to something like a geopolitical landscape.
Carina, from your perspective, some would suggest that fintech and the new banking technologies have an unfair advantage over the heavily regulated, let's call it traditional banking profession. Is that fair, or is that something that's changing? I'm keen to hear your view on that.
I would say both. So one, yes, I think they had a clear advantage against the traditional banking, especially the fact that they're not as stringently regulated as normal banks or traditional banking, if I can call it. So they had opportunity to break ground and test and try different ways of serving clients that we haven't been able in the normal financial sector. Then the second point was, is it changing? Yes, I think regulators have seen how fast this can reach, and the potential risk that is out there that requires a more control, if we can put it this way, or measures to ensure that we're not putting the system at risk. And maybe just a last point is that I see as a way forward that there should be a much better collaboration between regulators, traditional bankers, and fintechs. And I want to just spend a little bit of time on this one. So when you look at banks and fintechs, or traditional banking and fintechs, when you talk about collaboration, I think there is an ecosystem that can be built with both, not one or the other. Banks have got and built years and years of experience in ensuring that we provide services that are in a stable environment, a sustainable environment, and do cater for beyond banking as well. So needs from customers that not just banking requirements. From a fintech perspective, I think we bring in a new way of doing banking, a new ways of thinking and solving specific problems that banks have failed to date to solve. And I think the combination of those will help us to provide a much better service and outreach from that end. And from a regulatory perspective, I think there's the more flexibility, if this word exists in that dictionary, to help them continue with this advancement. And I think here is to call for a fail fast. So if you want to solve a problem, you're allowed to solve a problem. And if you have to fail, make sure that you fail fast, so that we don't create a much bigger risk in the future. So creating this opportunities to test, try, validate, whether you carry on or not. I think this is the collaboration that needs to play between these three players.
So it strikes me, and there is a big existential question coming from one of our fellows of the Institute that I'll get to in a moment. IK, from your perspective around education, one specific point. If you are sitting in a middle or back office within the banking entity at the moment, how do you train yourself? If it's survival of the fittest and your competition is AI, how do you retain relevance as a human employee of a financial institution when the threat of machine taught skill set is coming at you? Any thoughts on that?
Definitely. My advice would be you do what AI cannot. So it's similar to advice I would have given before AI, where I would say the basics of your job are the non-negotiables, right? That's what you're expected to do. And it's actually an opportunity where if AI can do a lot of the basics of the data crunching and the calculations of what you need to do, it gives you the opportunity to reach out and see where are the pain points within what we do as a company and how can we solve them? Who can we reach out to collaborate? Here I see a risk forming. I want to give my input on if and how we can solve it. I think very often, especially when it's sort of middle management, they wait for a strategy to come from above, or they're sort of too afraid to speak out about something that's not within their area of influence or within their jurisdiction. But that's really what sets you apart. It's when you can also educate those around you about this is how we use AI. This is how AI is making our lives easier. And this is the time it frees up for me to make these connections, to be part of these programs. So that's the key thing I would say is, first of all, get to grips with AI and do you use it and how would you want to use it? And then potentially be the educator of AI within your company, but also do what AI cannot do. Do what only a human can do. Have the conversations, make the connections, build up the networks, be part of the projects, because that's really where you then have the added value also for the greater institution.
Well, there's maybe some specifics for the Institute team to consider later. There is a question that I can't ask the panel to answer, which is asking for specifics in the banking profession for roles that can be replaced by AI and those that require the human to perform. Many institutions will have significant differences in their abilities to do one or the other. So sharing examples is perhaps a takeaway for the Institute team to look at for a subsequent question. In rounding all of this together, there is a point that suggests, well, we're missing the point completely here, because the key question is, do we have bankers anymore? Because it strikes me, and it strikes the questioner, that their experience, and it is specifically UK, but I'm sure it's pretty similar globally, that people are recruited for standalone jobs with skill sets, and they may not even be lending bankers. They may be in design lead or various other bits and pieces. They move up and through the organization without any real understanding of deposits and advances and P&L and liquidity and regulation. And I wonder then, if I can go around the panel, Dee, firstly, you stepped out of banking to advise inside. Do we have bankers now, or is it just we are a wider portfolio of skills? Whereas decades ago, there was a much more well-trodden path. Is that fair? And is that fit for purpose in your view?
That's a good question. I think it depends. I I would take a slightly different view. Most of the bankers that I know do tend to move around and do have broader experiences within organizations. So I don't think it's necessarily a fair way to paint things. But actually, you know, as an industry, we should be recruiting from diverse backgrounds. We should be leaning into different experiences. And so that means there shouldn't be one particular model of a banker. I think we definitely need to lean into that. But what that does mean is that there is a responsibility for us to instill a culture of continual learning, to make sure that everyone is on the same page or brought onto the same page when it comes to things that we think are non-negotiables, like regulation or like keeping the client at front and center, or even banking fundamentals. So I think it's okay. And actually we should make sure that we bring in people from different backgrounds and knowledge sets, but that we upskill them to keep a level playing field and make sure that we keep the skills that we need.
Carino, from your perspective, should there then, so the counter argument is, should there at least be a basic understanding of what we would call the core tenets of banking? Or, as Dee suggests, do we need to have a multiplicity of skill sets to suit the complex world that we're now operating in?
I mean, this is a complex question to tackle at this point. I think that,
and you've got 30 seconds to answer it, so I'm being very unfair.
Very, very unfair. No, I think there's two things. One is that the way we have seen banking to date is certainly going to change, or is changing. We don't have that same exposure, interaction with banking that we have. And certainly we're going to see banking, not just the front of our engagement, but by the way. So you would want to look at the product, and then banking would be behind the scenes. And that's why I agree with Dee. It needs to be a collaboration between bankers and those who are in other fields offering products that you and me need every day, right?
Thank you. Arike, final word from you on that, or any other point?
I'm glad we're at the end of the panel, because I run the risk of being kicked off. My question would not be, do we still have bankers? The question I think we should ask is, do we still need bankers? And then really delving into that and see, what is it that the banking profession bring? What is it that the world needs from bankers? And then taking it from there and see, how do we fill those needs with what type of people? But I would ask the question for, do we still need it? So we can really get to the bottom of what it means to be a banker and what is the value you add.
Correct. So are we still relevant? Now, there is a question that many professions ask themselves from time to time. So the hands of my clock, because I have an old clock with hands, some of you will have numbers that flip round, has moved to the end of our time together today. All that remains is for me to remind you to tune in tomorrow for day 2 of the Chartered Banker Institute annual conference. And tomorrow they will be looking much more at the world of learning. Also, remember to log this as part of your annual CPD effort, because as a profession, we require you to do that. So to our panel members, a debt of thanks for their insights, opinions, and their willingness to speak on a public forum for all our benefit. Not everybody wants to speak publicly on such things. I know I learned a great deal from the points they've made, and I have also some homework too. That's probably a good day at the office. So finally, from the entire Chartered Banker events team for creating the forum, and that's the means by which we've beamed into your busy professional life, our collective thanks to the team at the Institute too. They will be bringing you the Young Banker of the Year Grand Final in a few short weeks, and you can find out about that event on the website too. So for me, Bill McCall, until we meet again, I leave you with this thought. Both Steve Pateman and Dame Susan Rice referred to stewardship, and it's an onerous responsibility that we as professional bankers seek to deliver. So to do so, to be good stewards, we must take responsibility for our personal role. We must take responsibility for how we treat our customers and clients, and we must take responsibility for our organizations and their actions. So we must hold ourselves and others accountable. So let's all go and do those things for the greater good of our profession. So until next time, thank you and goodbye.